Hello, Matt. Good to see you. Incredible few days here for our favorite stock, Tesla. We'll be talking a lot about that today. How's it going?
Very good, thanks. Yeah, it's been a crazy week, crazy couple of weeks, really. I mean, this rally has been going on for, a little over a month now. So certainly every day seems like it's getting better than the previous day. So yeah, I think I'm not unlike anyone else. It's just feeling very excited about where things are right now. But how about yourself?
I'm doing well. It seems surreal. You just think every day I wake up, I'm like, is this going to be the day we kind of come back down $100, and come back to reality a little bit, and it goes up another 50 or 100. Yesterday $110. Insane. And today it was up to like $190 at one point temporarily. I mean, just watching it go up and down so quickly like that. It seems so, like, I guess unhinged is the word I use. Like the market makers have kind of lost control of this
Yeah.
stock, and they're like, I don't know how to set a bid offer spread, and then you just have these day traders and retail traders driving up, and it feels like kind of like one of those meme stock movements that goes up and down wildly so fast right now, and you kind of wonder where it's going to settle out.
Yeah, it reminds me a bit of 2020 right now. I mean, we had a couple of those days in 2020 where it'd be up $100 plus. There weren't many of them, but there were a few, and volatility in general was just much higher than. 2021 so far has seemed much more mellow. Obviously, we had kind of like the big consolidation, touching back down under 600 for a while, and the stock was, more reasonable kind of daily movements of like 1%, 2%. So kind of having these sustained levels of, much more drastic daily movements, and then up, it was at 110, $115 yesterday. It was just, yeah, it's like you said, the market makers seem to have kind of lost control of this. It's kind of blown through all the resistance levels, and it's not clear where it's going to go. So
Yeah,
it's been interesting to watch, a lot more exciting for sure.
yeah. Before we dive more into Tesla, we usually start with the macro markets. Anything of note that you're thinking about or seeing about the macro markets? I mean, I know there was that tweet with Jack Dorsey and Elon Musk kind of piling in about hyperinflation or inflation, and Kathy kind of threw some cold water on it a little bit, and she's like, "Calm down, guys. Like, I don't think this is something that's too serious. It's transitory. There's other things coming up. I don't know. What do you think about that whole thing? That's sort of like the macro market, signal in my head is when you have Jack Dorsey, Elon Musk, and Kathy Wood all talking about something. It's sort of like, pay attention. What do you think?
Yeah, I think I'm a little bit more partial to the inflation is a real risk line of thinking. We've talked about this for a couple of these weekly interviews that we've done now.
Yeah.
But the government has never been really spending at these sorts of levels. And if you look at like debt to GDP, it's at like World War II levels now. But I think the thing that's different is after World War II, there was a pretty massive, demobilization of a lot of the government spending. Troops got off, army payrolls, and there was, spending increases, and there was I think a general sense that you wanted to balance the budget and kind of, start clawing away at that huge debt that was ramped up. And
Yeah.
now I think you've got like almost the opposite. There's this modern monetary theory which just assumes that debt doesn't matter. As long as it's not like 300% of GDP. I don't know
Yeah.
what the actual theorists would say.
Yeah, back
Um,
then, World War II, like we were still on the gold standard, right? I mean, now we're
yeah,
not on the gold standard, and that allows modern monetary theory to sort of take over, and the ability to print more money indefinitely if they really need to or decide to. It's a whole new option that before being on the gold standard wasn't really an option.
yeah. So that's a real risk, and the way that the this has always been fought in the past is by raising rates. But if the Fed starts raising rates, then like the budget gets even worse. So it seems to me, just trying to play this through from first principles a little bit as much as you can. Nobody really has a perfect crystal ball. But it seems like something's got to give in this equation. Either you've got to, tax like crazy or cut like crazy, or just inflate your way kind of out of this by printing more money. And I think that's what's most likely to happen, which could lead to, maybe it's not hyperinflation, but certainly a lot more inflationary pressure than we've seen in our lifetimes. So that's kind of what I think will happen. I do think Kathy has a point, though, that there will be a lot of technologies that kind of provide a counteracting deflationary sort of pressure. So, but I think in the short term, and maybe for some commodities and for some areas of the economy, you will see a lot of rising price pressure. I think we're already seeing that in wages kind of across the board. Every business owner I know is having problems, retaining employees and needing to raise wages.
Yeah. Mm-hmm.
So yeah, I think that's going to be a real issue in the short term. Could impact equities, but in the long term, I do think Kathy's deflationary, thesis makes a lot of sense.
Yeah. I mean, I think there's a lot of change going on, and I agree that deflationary pressures will offset the inflationary symptoms you see going on right now to a large degree. But there's so much change in terms of labor displacement, so much automation and AI advancements that Kathy's talking about. Yeah, that's true. It's going to make production of companies much more efficient or much better. But at the same time, you're going to have labor changes in work, in employment. Truck drivers will be automated away. Fast food workers will be automated away. Like there'll be new jobs, like DoorDash drivers is a big thing, for example, now, or Instacart drivers and delivery people. So it's gonna be a whole, there's a huge cyclical change of labor allocation going on. But I think there's going to be a net loss of jobs overall, like manual jobs that are going to be hard to replace with new types of jobs. And you're going to have a whole ton of people that are going to need some kind of helicopter money or UBI or something, negative income tax, to encourage them to do something. You're going to need something to offset, I think, kind of the disruptive job displacement going on because of these technological deflationary forces. So it's going to be a crazy decade, and we'll just see what happens. That's my
opinion. I think you're right. And my own background in energy seems like the perfect microcosm of how this is going to pan out. I mean, the company that I was working for had 8,000 employees, and they kind of grew their revenue by 1% to 2% a year, mostly by raising electricity rates on their customers. Yeah. And they've got this huge overhead staff. They've got power plants that are more costly just on a marginal basis than new solar or wind. And at the same time, they've got all these overhead costs and debt on their balance sheet that needs to be serviced. And so they've kind of got this model that is very rigid and can't really cope with decreases in price on energy. Yeah. And so you've got this new technology that's going to come in. So you're going to have, winners like Tesla who are going to come in with a solar and battery option that's going to be cheaper than your utility rates that are just going to continue to rise 1-2% every year. Mm-hmm. And so you're going to, take a lot of that volume away from those companies. And I believe eventually they'll kind of collapse under the weight of their own cost structure, because they've got this inflationary pressure, and meanwhile there's this deflationary new technology that's going to disrupt, and it's going to leave a lot of those great employees who I worked with and really liked, but I think it might leave them in a hard place. So it's going to be a good thing overall for the economy, because you're going to be transitioning to lower priced alternatives, but there's going to be it's not going to be a smooth and gentle transition where everyone is, going to be winners. It's going to be very hit or miss how it impacts people.
Yeah, absolutely. Yeah, so it's going to be fascinating, but there's a lot of ups and downs. It's going to be bumpy, as you said, not smooth. So right now we're in one of the bumps with some of the inflationary headwinds we see right now, I think, and we'll just see how it plays out. Macroeconomics is very, very hard to predict. So we'll see. So moving on, I guess another thing we wanted to talk about was Snap. I mean, that's a stock we like. Took a huge hit from their earnings.
It was down 33%, I think, in one day right after earnings. It was a huge decrease.
It hasn't recovered yet, right? I mean, it wasn't like a temporary blip. It wasn't like a flash crash. That thing is still, pretty. It's like in the 50s right now. Last time I looked. I mean, it's. Let me look right now.
Yeah, it went from around 74, I think, to 54, 55.
Yeah, I think it was 120 or 130 billion market cap. Now it's an 87 billion market cap, and basically overnight got cut down by 25% or 30%, somewhere in that range. And I guess the earnings, they said that Apple, the advertising is less profitable for them. The targeted advertising, is that right? Because of Apple's new
Yeah. So
policy. That's what it was sort of blamed on.
Apple has been, they pushed out in Q3 this new iOS 14.5, which had, some user privacy changes. Snap was kind of aware that this was coming, thought they could, more or less muddle through it and kind of figure out what the changes were, and can kind of reestablish their advertising business in the same manner that it had been, prior to this iOS 14.5 update. What they found instead is that they were having much more difficulty actually, providing that targeted advertising that their kind of existing customer base was relying on, all these advertisers for these brands. What they said on the earnings call, which I thought was pretty interesting, is that the brands have really pulled back on the advertising just because they can't, really clearly target those individual users that they were finding. But they did say at the same time that when they do their tests to kind of check on the effectiveness of the advertising spend, and all the indications that they're getting from the data so far is that the advertising is just as effective as it had been before, but they're kind of having a harder time justifying or making the data kind of show the way that it used to, how effective the advertising really is. So they lowered their guidance for Q4 by quite a lot. And so I think the question that the market's trying to figure out right now is this kind of to use the word of the moment right now, is this a transitory issue, or is this something that's going to, be a permanent impact for companies like Snap that can no longer advertise, can no longer reach the customers in the same way that they used to provide that, kind of very clear value proposition to their advertising, clients. So I think it's going to be a shorter term issue. It's clearly their number one issue right now, is their priority to try to sort through, this big change. And like they were saying on the call, that the preliminary data seems good. It's just, you got to kind of repackage that value proposition. So I think this is going to be a short-term setback, and I really like the longer-term kind of VR AR business that they're really trying to drive to in the future. I think that's going to be more important than kind of this short-term change in advertising metrics.
Yeah.
But what do you think?
Yeah, I mean, I'm more of a bird's eye view, trying to see the forest from the trees on Snap and the big picture of where the future is going with the augmented reality and metaverse, and how it's sort of like seems like Evan Spiegel is one of these, incredible founders that has a vision that he's pushing and runs a tight ship. And I think there's still a lot of promise in Snap rising and becoming bigger than Instagram, and sort of like a rival to TikTok in some ways too. But also they have some incredible camera technology of bringing like reality into the virtual world, sort of, so to speak, kind of blending them together into an augmented reality. So I kind of see them at the forefront of that still. And like you said, that story hasn't changed. So medium to long term, I'm still bullish on it. The market cap at 80 something billion, their total addressable market for anything metaverse related is pretty huge. So I think there's still a lot of upside potential in the long term if they execute well. But in terms of the quarter to quarter financials, that's what I have you on the team for. Help me kind of have a picture on that. But long term, I'm still very bullish. Yeah.
Yeah. The interesting thing was their Q3 numbers were actually pretty good. They were on the low end of guidance, but they still kind of met guidance, even considering this massive change that kind of came up midway through the quarter. So clearly the stock got hit on kind of the future outlook. So they lowered Q4's guidance. I think Q4 is going to be a huge impact. Not only what do they actually post in terms of revenue and earnings.
Expectations must be a lot lower for Q4, you'd think, at this point, right?
Yeah, well, clearly, yeah, absolutely. I mean, they kind of specifically lowered guidance.
Yeah.
But I think the bigger picture here is not what Q4 earnings are going to look like. That'll impact sentiment and kind of short-term movement. But the bigger trend, which I think is much more important, is kind of retail is continuing to die, and so all these brands that used to advertise or used to kind of use other media outlets, maybe advertising on TV. It's just very clear that that's not as effective as it used to be. So I think ideas like virtual malls or like virtual spaces where you can kind of try on things, and brands have individual experiences that they can kind of customize. There's some really cool things that Snap is really leading the way on that I think will be a lot more valuable. I don't know if it's 2 years from now or 5 years from now, but that's the story that I'm much more excited about.
Yeah, me too. The future. Yeah. Most people look out 1 year, a few quarters, and it's hard. A lot of Wall Street at least looks out that far, but doesn't really see the picture that well 2 to 5 years out. We've seen that with Tesla, for example. Yeah. So speaking of Tesla, man, this thing's dropping, knocking on $1,000 again on the doorstep of getting below $1,000. Oh my gosh. As we've begun talking, it's really this thing's so volatile right now. It's like, wow, it's this thing could close to, the way it's moving, it could get to the mid 900s by the end of today, or it could get back to 1,080. It wouldn't surprise me either way. It's just so volatile right now. Those options must be super expensive right now, right?
Yeah, I've been looking at the weekly options for a while now. And kind of before this all took off, if you entered an option at the money, like on a Monday morning, generally they were priced around like $12 or so. Yeah, I was looking today. So on a Tuesday, you're taking off, 20% of the time value, and it was like $34 for an at the money strike this morning. Wow. So it's, implied volatility has kind of gone through the roof, but it should. With these kind of drastic swings, we're moving $90 in a single day today. It was more than that yesterday. So
market makers very unclear hurdle. Yeah, they don't know what to do. And let's talk. Speaking of options, I think we were going to talk a little bit about our options. We had a big options bet we put on like 2 months ago for when the stock was around $720 at the time, I think, when we put it on. Yeah, it was November 19th expiry, and it was 900 call strike. We bought for like an average price of like $8 or something, like a bunch of.
Yeah, so I think we initially put it on at around like $10. Yeah. The stock kind of stayed stable for a little while, and it dropped to $5, and so we doubled down. We're like, I can't believe that's only trading for $5. So we doubled down. We had a pretty large portion of these, 900 call strikes.
1,000 of them. Yeah, 1,000 of those contracts. Yeah, and we watched it slowly go up over time to like 15. It went up to like $20, and we're like, wow. And like the first few weeks, then it went back down towards like $10, and slowly went back up to like 14. And like a week before earnings, it was at like $13 or $14, and I was like, let's just sell half of them now, and hold on to the other half. We'll hold on to the other half till November. I was thinking. I think I said to us. And
yeah, we were both on the same page with that.
We're both on the same page. We sold half at like $13 or $14 to get most of our money back, so we could hold the rest kind of like with house money. Sort of like what I did with the S&P options bet a year ago when I sold half in like December and kept the rest with like just thinking, all right, I'll hold on to the rest until January. So that's what we were thinking. And then then earnings came, and it went up, and we were like, wait, earnings is great, but every earnings the stock sells off after. We were convinced, and we got like kind of cute, and we were like, all right, let's just sell it right before earnings at $20, and we'll buy it back for like $15 or $10 the next morning when the stock gaps down. And sure enough, the opposite of what we expected happened, and the stock just took off and kept going up and up, and it would have been a 50 or 25x return if we just held on to it. Yeah.
Yeah, so when the stock was at like 1,090 or whatever earlier today, I'm sure that would have been worth, that whole, we had 1,000 of those contracts. So, that would have been worth almost 20, like it would have doubled our fund just with that one position alone.
I know.
We had a nice, 2x return on it roughly. Our thinking, which I thought the thinking was sound at the time. Obviously we weren't quite right, but with earnings, even if the stock goes up like $20, let's say, on a good earnings report, the implied volatility on an out of the money option like that would generally collapse. When you've got a significant news event coming out of there. So we were thinking there's a good chance, we sell it. I forget what it was, 15, 17 something, or no, it was 20, 21. I think we sold the second. So we're thinking, all right, even if the stock's up a little bit, we'll just re-enter the position at like 18 or 19, worst case scenario, maybe even like 25 or something like that.
Yeah.
And instead the stock just like rocketed and never stopped.
Yeah.
So it's, I think we've had a couple times where we've made these sorts of bets that, our thesis was wrong. And so we've been burned on them. This time the thesis was right, and we just kind of didn't hold it long enough.
Yeah, it's painful. Yeah, every day we've been chatting about, oh man, those 900 calls. If we just held on to, it's like we've done very well. We still have a lot of Tesla exposure. We have in our fund.
Yeah.
And that's
to be clear, the fund's doing very well in this environment, right?
Yeah. But it would have been an incredible month if we just stuck to our guns on that one. Yeah.
So what's your takeaway? I mean, we had an incredible 2020. Kind of a solid 2021 for sure. I mean, we're doing pretty well in the fund. Tesla's doing really well. I think we've mitigated the downside earlier this year and certainly taken advantage of the upside, but not without our fair share of misses along the way, which is to be expected. But if you were to kind of summarize what you've learned this year relative to last year, are there any meaningful takeaways, or is it just this is what you expect when you're going to play in options?
Yeah, I think it's sort of what you expect, but I think what we could do, or is when we do those options bets, like that bet we did for the 900 calls, we knew that it was likely going to expire. We looked at the probability lab on Interactive Brokers and saw it had like a 10% chance of being above 900 by November, and we're like, no way, that's like a 25% chance in our minds, so we knew it was probably not going to happen. In our minds, like we didn't think it was likely, but we liked the difference between what the options were pricing it at the time versus what we thought the probability was. And that's why we took that bet. So we've done that a few times. We tried something like that with Zoom, and that kind of scarred us. I think we were up like 5x, then we held on to it. And it turned to like 0 because we held on to it. And so I think that scarred us on this one, and we remembered that. But I think we just have to kind of be consistent and know some of these bets are like, even though they're probably not going to be 0, when they're right, they're going to be a 20x or 10x or 20x, maybe more return. And so maybe we just have to like write down in writing, like on a Post-it note next to our computer screen that we would normally click on to sell to close the position. So remind us like, hey, we wrote this down, like we're going to stick to our guns. Like our plan is to sell like maybe half of it when it goes up X amount, so that at least you can make your money back and then some, and then keep the other half as like to see if your thesis plays out, and sell it at a certain and decide. So it's not an emotional decision or trying to like think like we can track like there's always new information coming in, which is tricky. But I think it's hard. But I think writing down like the thesis and just sticking to that, if you write it down, is probably what I would say I would try to do next time. I don't know. What do you think, man?
Yeah, no, I mean, I agree with that. I mean, we've tried that a couple times. I think we're probably getting a lot in the weeds for some people, but I do think it's kind of interesting. Managing a fund professionally is, I think your responsibilities are a little bit different than if you're doing this in your own personal account. So I think that's part of the reason too why we've not been so public about this trade in particular. We didn't necessarily want people to kind of follow us into what we viewed as a fairly high risk, trade. So I think we're always going to do that, one, to kind of protect our investors and, give them the benefit of some of our unique viewpoints here. But also just to, we want to avoid giving investment advice. But in this case, we've had some rules like that in the past where we said, all right, if a certain position gets up to X level, we'll sell, and we've had, I think, several cases where the position just never got up to that level, so it just kind of slowly whittles away over time. So that that's certainly one outcome. So you sort of need scenarios on the upside and scenarios on the downside, and then a lot of times your view on something will change given 2 or 3 weeks. Frankly, just like the 900 calls when the stock was flat and the calls value dropped in half, I thought that was crazy. Now at $5, those 900 calls for November just looked insanely cheap to me, especially given kind of our view on where we thought earnings would likely end up, which proved to be accurate relative to where Wall Street was at that time. So it's a learning curve, but I think certainly just happy with where the fund is overall right now, and it's been really fun to kind of be a part of this.
Yeah. Yeah, you can't do all the perfect moves, obviously, but it was a winning trade either way, and we're happy about it.
We'll take our 2x. I mean, most funds would
Yeah.
be happy with that, a 2x
Yeah.
return in like 2 months or something like that. I forget exactly how long it was.
Yeah. Absolutely. So the Hertz deal, that's the big news. I went on Dave Lee's YouTube channel last night, kind of last minute to talk about it. We went over a lot of details. What do you think about the Hertz deal, Matt? What are your thoughts on that?
Yeah, I mean, I loved it kind of right off the bat. 100,000 orders was like certainly a huge volume. I mean, I didn't expect that sort of volume to come from any institutional, buyer or corporate buyer, I guess. So I was just surprised at the sheer volume of it, especially when I did a little bit of digging and found out that, so Hertz's fleet is like 500,000 units, something like that altogether. So it's a really sizable percentage of their entire fleet. So, the order size was, really impressive. And to me, like the easiest takeaway is just that it kind of makes the 2022 projections a little bit easier. If you were at all worried about demand, not that we were, but that's just makes it even easier to see that demand's not going to be an issue. It really is a production problem, like Elon said in these tweets. But the thing that I think I'm a little bit more excited about is just the fact that this is going to be rental units. So I mean, everybody who I've given a test drive to, or has just like seen a Tesla for the first time, they're like, "Whoa, this is amazing!" Because they know about them, but they've never actually experienced one. And so I think that's going to go a long way towards getting more demand in the long term, and just I think awareness about EVs in general and Teslas in particular is still really low. If you look at the overall general population. So kind of. I can't think of a better way to kind of spike that knowledge in the customer base than by, getting, EVs out there for short-term rental periods. So I love it. That's the part that I'm probably more excited about than the actual demand.
Yeah. I mean, Mark Fields, the previous CEO of Ford, or prior CEO of Ford, now the CEO of Hertz. I mean, there's a lot of backstory, a lot of detail, a lot to read between the lines with this. That's what I find the most fun in this stuff, is reading between the lines and speculating. And, sometimes I read too much and I read too much into things, but sometimes I find like interesting tidbits that turn out to be true. And I just love trying to speculate on this stuff. But I mean, Elon, obviously his stamp of approval is on this deal, right? It's a big deal. It's not just some regular customer that he has nothing to do with. Like, he had to approve this special deal. And so he's giving he's vouching in a way for Hertz. And, he wouldn't make this deal. They have plenty of demand. Like, they are not demand constrained whatsoever. So there's something here that Elon sees in Mark Fields and Hertz, I think. And maybe there was some discussion directly between the two, and they're open to making this a robo-taxi fleet, or that's what their pitch was to Elon. Elon's like, okay, I don't know. There's something special about it. I can't quite put my finger on it.
Do you think so I was thinking about the autonomy angle here a little bit. I think that's maybe going to be the hardest part to educate consumers about. And I'm wondering, if Hertz would even want to purchase full self-driving for many of these.
Oh, definitely. I think they would at least do the subscription for a large amount of them, and they would charge their customers, $20 a day for the extra access or whatever it is. I think they'll at least do the subscription, if not the full self-driving. What do you don't think so, though?
Yeah, I'm just not sure with the beta. I mean, I could see next year sometime, if it's a little bit more smooth, I could see them, wanting to have that, and maybe there's some sort of contract that kind of allows them an option to buy at the current price or something like that. But if you've got people kind of driving a Tesla for the first time, which is frankly a different driving experience. I mean, there's a lot to get used to if you're just coming from a nice car driving your whole life. Probably especially regenerative braking. But full self-driving, I mean, it requires a lot of oversight with the way that it does things right now.
Yeah.
So
in the current state, you're right. I think you're right in the current state, but I'm thinking like Elon in his
yeah,
mind, and probably in a year from now, end of next year, when they complete the order, like I think he's thinking that robo taxis will be able to be turned on, give or take a quarter or two of timing, but that's about the timeline where I think it'll be turned on and be the largest asset price increase in history that he's referred to. And
yeah,
so I think it's at that point, these cars are no longer rented to customers. This is a fleet operation of robo taxis that Hertz manages, and so you're not renting the car out to an individual. I think Hertz is now a new business model for that segment of cars. Like maybe they'll have a few of the electric cars for people to rent here and there, but I think the vast majority of the Teslas will have full self-driving level 4/5 enabled, be level 5, whatever, and be able to, and have the capability to. Maybe in Europe it might take an extra year, but in the US,
yeah.
more likely with regulations or whatever. But in the US, but they would, in Elon's mind at least, and he's usually correct on this stuff, give or take a little bit of time, based on his timelines, but it will just be Hertz running a fleet of robo taxis. Like we've talked about it before. Like you ordered a bunch of Cybertrucks hoping to do that. I ordered a bunch. But now Hertz ordered 100,000 Teslas, and they're taking.
They're putting us all to shame.
Yeah, yeah. Like Florian, the guy you interviewed from Mr. Green, they're basically
Yeah.
going to be a much larger version of what he's doing or what he's planning to do. Like it would be good to pick his brain on it and see what he thinks, because that he probably has a lot of insight on this too.
Yeah, yeah. Maybe we should get him back on here because it's a pretty meaningful development, and it really is kind of option value on the future. I mean those assets that they're buying for full price now at call it $45,000-$50,000. It could be worth $120,000, $130,000, something in that kind of ballpark, overnight if this pans out. And so then if you think about what would that do for Hertz's market cap and for their business model, it's pretty remarkable. Now obviously there's a huge amount of execution risk in there, on Tesla actually needing to not only get full self-driving to the point where it's good and reliable, but there's regulatory risk and a lot of things that would need to kind of go right to get to the point where there's actually robo taxis. But the downside here I think is probably zero, because these vehicles are going to retain their value better. They're going to cost less to fuel up. They're going to cost less in maintenance. So I think Mark Fields and the Hertz team is saying, okay, the total cost of ownership is really low for us, especially for a rental company, which only typically holds the vehicles for, I don't know, maybe a year or two, puts on 10, 20, 30,000 miles and then typically sells them. Resale value is like the most important single driver in their business model right now. So even if autonomy is not in the cards, they're still going to do really well just from retaining this residual value, much better than ICE vehicles do today. And if you fast forward 3 years to the point where they'll actually be trading these in, I can imagine ICE vehicle residual values will be much lower then, and probably EVs residual values will be even higher. So
now, how about this? How about Hertz? Sort of like not a meme stock or a SPAC, or HTZZ. It's not on the exchange listed again. Once it's on the exchange listed again, more people will be eligible to buy it again. But what if that stock starts creeping up on this news? It's 12 or 13 billion market cap. What if it creeps up to like a 20 billion market cap company because of this? Then they announce another deal to buy 100,000 Model Ys, and it creeps up to like a 30 or 40, and then they raise capital to buy another 100,000. They could be like funded by the public who are buying into this idea of a massive robo fleet of taxis. That's kind of, it's separate from, it's not part of Tesla, but it's the biggest robo fleet using Teslas. I don't know. It just seems to be something more potential that could develop out of this. That's like really interesting. So, there's a lot of, I'm just imagining like the possible upside.
Yeah. I was digging into their S1. So, they're going to be, traded. I don't know if it'll be on the New York Stock Exchange, but they're only over the counter right now. And so they're trying to get to a broader population right now, which I think is good. I mean, their valuation is pretty reasonable, I think. Right? I mean, they're basically just valued like the other car companies. I think it was like 12 times EBITDA, something like that, or sorry, other rental companies. So I think there's a play there. You know, the question in my mind is like, if you were to just say buy a Leap, which you can't do right now because it's over the counter. But say you got like a January 2024 Leap, it's probably unlikely in my mind that autonomy is going to be, robo-taxis will be ready like by then.
Right.
Maybe they will.
I'd say that's my
looking
50-50 mark. January 2024 would probably be my 50-50 mark.
I guess I probably need to see a little bit of what's the rate of improvement, especially once Dojo goes live, which I don't know if you got a chance to see that paper that they put out today.
I haven't read it yet, but I'm looking for. I bookmarked it in my tweets.
I felt really dumb when I tried to read it. I was like, okay.
Sometimes these things you feel dumb. You just want someone on Twitter to like explain it in layman's terms that you trust, And
James Dalma did a really great job.
Yeah, I saw his thing. Yeah,
kind of summarizing it.
I almost feel dumb reading his tweets sometimes. I have to really focus to like pay attention and understand what he's saying.
Yeah, I think the main takeaway I had was, the existing programming language that's out there right now doesn't really work well for Dojo. So they're trying to get out these alternative. I think there were two different languages they were proposing, and so if they can get programmers to start using that, then that can enable Dojo to be used in other applications beyond just kind of Tesla's internal team. So to me, my takeaway as an investor, and I need to dig into it more, but it seemed like a signal that they're thinking a lot already about how to kind of monetize Dojo, or at least use it for use cases more broadly than just kind of the internal Tesla team. So that I really like to see that. So it makes me encouraged and excited.
Okay. Yeah, no, I'm looking forward to that. Read that and understand it better. I mean, we can talk more about the Morgan Stanley upgrade. I haven't really read through it carefully. I've seen a bunch of these Morgan Stanley research reports and Goldman. A lot of them, I feel like once I read a bunch of them, nothing really stands out special from them. Like the fact that it was Morgan Stanley is a big deal, obviously, because they have such a huge wealth management practice. But was there anything? Did you read the report? Is there anything that stuck out to you about the Morgan Stanley?
I mean, I've read these Adam Jonas reports for a couple of years now, and like every time I read one of his reports, I'm like, he kind of gets it, but like it's not like reading through there's anything that I'm like, oh yeah, like that's a really good point. I hadn't thought about that. It seems like he's a little bit kind of behind the curve of maybe where some of the retail analysts are. But he's, to your point, he's got a lot of clout with institutional or like the broader Morgan Stanley kind of like wealth management allocators. So the fact that he's bullish on it, I think is a good thing. But I mean, I just think back to his question on like one of the earnings calls recently of like, oh, are we going to put Starlink on like Tesla on the Cybertruck? And he like, for some reason, he thought that was going to unlock like huge amounts of value. And he was like, no, probably not. We won't do that. So I don't know. It just seems like he's a little off base with what he thinks is important versus not important.
Yeah, he said, I mean, I actually like that question.
Oh, really? All right.
That's up my alley, that type of question. But he does ask a lot of questions that don't make sense. You're right. But yeah, there has been he's trying to like combine SpaceX and Tesla in certain ways. I think he wants to be kind of, he's been one of the in the institutional Wall Street sector. He's like the top auto analyst, I think, and he for a reason, and he wants to keep. He's smart in some way. They've been so right on Tesla early on. Like I remember he went on CNBC and was like, we are witnessing the birth of a new American car company. That was like in 2013. He said that, or 2014. I was like, yeah, he gets it. And then like a year or two later, like he needs to like say something bearish or put like, last year, 2 years ago, put a $10 price target on Tesla for the bear case. Like, I don't know. It's like he flip flops too much.
Yeah, he was very flip floppy. Because he like I want to give him credit for being like kind of a middle of the road analyst, because he's not like a Uber bull and he's not an Uber bear. But like some of the stuff that he puts out there, like that $10, I think it was a bear case target, but it was like, why don't you just say 0 if you're going to say 10? Like, because that was pre-split, I believe. So it was basically saying they might go bankrupt. Like, why even bother with the $10?
They're trying to appease all their clients, the bears and the bulls, and I don't know. There's something that just seems inauthentic about it, salesy about it. That rubs me the wrong way a little bit.
I agree.
Yeah, so I guess you got 10.3, you tried it out, right? I mean, the first time you tried it out, you got full self-drive and it was like the buggy version and there was some issues, right? Or you texted me a little bit over the weekend. And tell
Yeah.
us a little bit about your experience with full self-driving 10.3.
Sure. So yeah, I got the, that short-lived version that went out on Sunday. So, I drove that around for like 5 miles. It was pretty buggy. Now I didn't have anything to compare it to at that point, so I'm not sure exactly, which of these issues were just like the actual beta versus, that kind of buggy version of it. But yeah, I had like a forward collision warning when nothing was happening. There was kind of a lot of like sporadic braking. And then the biggest issue, I think, is just it really was struggling with lane keeping. So I was on a lot of kind of residential roads that there's some areas, without going into too much detail, where there's kind of an unmarked passing lane, so it kind of widens out so you can like turn into a neighborhood. And like the car was just always kind of like swerving in and out of these and
You think
one
it
time I
was
was actually
unsafe, or was it unsafe, or do you think it felt strange, but it was unusual to how you would drive?
so for the most part it just felt unusual. The only time it was potentially, it wasn't even dangerous, but there was a car behind me, and so I had my blinker on, and it was kind of swerving into the passing lane to take like an exaggerated left turn wide. So I had to, take over to prevent that, because, then the person would just be really confused. All right, he's got his left blinker in and he's, merging off to the right. It was just strange.
Yeah.
So I took over on that. There were there was actually some roads closed. And so I was trying to see if it would navigate around, these closed roads, and it didn't appear to be doing that. But I also maybe didn't give it enough time because I had a lot of cars behind me. So that first drive was, certainly not relaxing, I would say.
Yeah.
Got the updated version yesterday, and it definitely seemed more smooth. There was still some of that kind of lane keeping issues, but generally speaking, it was a much better experience the second time around. So, I mean, I've heard some people kind of say that, they think that the full self-driving is like a more relaxing experience than driving on their own. From my perspective, at least right now, it still is. It's a less relaxing experience, because and I've only done it maybe, 15, 20 miles. So my view may certainly change over time. It just as I get more used to it. But I know my wife would hate it. So like, I'm not gonna drive it with her in the car.
Yeah, I
would
would
drive her
with my
nuts.
wife either. Yeah.
But like for me, I'm just like a nerd. I love seeing, okay, what's it trying to do right now? What is it thinking? I love kind of trying to experience that. And what I'm really looking forward to is just what is the rate of improvement from here. So all these issues, I mean, I had probably a dozen disengagements or so on these couple of drives that I did. And so I'm wondering, is it going to learn from that over the next couple of, versions? And will I see improvements in my own neighborhood?
Also, initially, I think a lot of the disengagements, it's sort of like the first time I was using autopilot, I would imagine, where like it's just so new and strange, like I'm uncomfortable just naturally with something else, like a computer controlling the car on the highway, and I would just disengage it out of, just a lot, way too often, because I just was like, whoa, I don't know about this. I'll take over before we have a close call here. But now I'm like to the point where I'm fully relaxed. And it's very rare that I disengage it, and even when I do still disengage it, it's probably not necessary. Do you think you'll disengage it less over time, more because you're just getting more comfortable, or do you think it'll be like you'll be able to measure actually how much better the system is getting?
Yeah, for sure. I think the right thing to do when you get the beta for the first time is just to be more paranoid and more vigilant. So I was certainly, disengaging more than, I probably will a couple weeks from now. I was
same software, for example. Yeah.
What's that?
Even if it's the same software,
even if
for like a month, you'll probably be disengaging a lot less than you are now, obviously.
Exactly. Yeah. I just don't want to have any accidents or anything at all. So there were even a lot of times, just like if you're, it would do a turn perfectly, like legitimately, but it just accelerates kind of quickly out of there, which is natural and normal. It's the way I would do it too. but like it gets like a foot away from a parked car, and I'm just like, oh my gosh, please, like actually hit that, and I'm gripping the steering wheel a little too hard.
Yeah.
I think that's the right behavior for
Yeah.
a new beta tester to have, to be a little bit
Yeah.
extra paranoid. But that's not to say that the car was making a dozen mistakes. That's not what I'm trying to say.
Yeah.
But yeah, it was a really interesting kind of experience, and I really can't wait to see how it progresses from here. The rate of change is going to be really interesting to track. Because I remember, like, a lot of I watch those, Dirty Tesla, Chris from Dirty Tesla, he does those beta testing videos. And a couple of years ago, he would do those like automatic lane change videos, and like it was horrible at automatic lane changes. It was just like a terrible experience. It would like abandon them halfway, and he's like jerking back, and it's like freaking out all the cars around him. And now it does that perfectly almost all the time. So I know that the rate of progress is the thing to watch, not kind of an assessment of the current state. Because I mean, anyone could look at the worst aspects of the current build and say, oh, it's unsafe. And I think that's kind of what you're seeing with some of this NHTSA, NTSB FUD that's going around with full self-driving. It's not actually full self-driving. And so I think the regulatory risk is real. And that's why I want to make sure that all the beta testers are kind of being extra vigilant to avoid any sort of accidents or safety issues.
Yeah, absolutely. So, okay, why don't we go on? We've been talking a lot. Maybe we can go a little longer for some Q&A and try to get to more questions, go an extra 10 or 15 minutes, if that's all right with you, Matt and Alec behind the scenes running it. And we'll start the Q&A portion now. Unless there's anything else you wanted to bring up, Matt, anything else you wanted to bring up?
No, there was so much news this week. I mean, we hardly even touched on the earnings call, honestly, but that's almost old news at this point after everything that's happened. But just a really big news week for Tesla in particular. So let's get into Q&A.
Yeah, let's go into Q&A and see. Okay, from Ben25 on Twitter, does Hertz advertising Tesla validate Elon's strategy of media silence or just an isolated incident? You go first, man.
I mean, to me, it does sort of justify it. I mean, the spending money on advertising when you are supply constrained never really made any sense to me. And so Tesla has remained supply constrained really since forever. And so like now they're in this situation where they've got almost a 6-month backlog. Maybe it's not quite that long overall. But Tesla should not, it would be a poor capital decision to spend money on advertising. What I think is kind of remarkable here is that Hertz, which is now essentially a customer of Tesla, is now spending to, advertise Teslas essentially. So Tesla's getting a benefit here, not only of the sale of these 100,000 vehicles, but also Hertz then spending money to advertise Teslas in general. I mean, seeing like a Tom Brady Tesla commercial essentially was kind of jarring. It was a little bit weird, but in my mind, it's completely justified. I mean, I would expect eventually this will change. I don't know if it's 5-10 years from now, but you probably need to spend some amount of advertising once you've got more of an equilibrium between supply and demand. But I think it still would be a poor use of capital for Tesla to start advertising. But what's your thought?
Yeah, I agree. Tesla and Elon do not need to advertise. The one thing that was interesting about this is PR. And, with Missy Cummings and this head of the NTSB being public about her lack of faith in full self-driving and request for Tesla to recall, she's really bearish on Tesla's full self or FSD. She was just interviewed this morning by Phil LeBeau on CNBC. I saw a clip and it was ridiculous. Like example of cognitive dissonance right there, I feel like. But, with all the regulatory, bearishness against Tesla's full self-driving and recall asking and such, like, I feel like it's great that now Hertz has significant skin in the game, and Mark Fields, who understands that landscape, because I think they'll go to bat to some degree. Like if you get a few more partners, like, in institutional clients or partners like Hertz out there that are investing billions of dollars in Teslas, and they want to see the full self-driving come to fruition because it makes their assets go up too, then they're going to take over the PR for Tesla or fill that void in a way and help lobby against, the unions and the legacy OEMs who are lobbying against Tesla, getting these heads of NTSB, pointed to fight Tesla, basically. So there's like a war behind the scenes, I think, going on that Elon is deeply principled and refuses to kind of fight in. But I think now that he's got like Hertz and maybe some others, who knows, will come online, those players will help kind of fill that void and fight against it to make it, less unfair. That's my thought.
Yeah, I mean, they could use some partners in this fight for sure. I mean, it's kind of been like the whole government against like Tesla in general and Elon in particular, and that's he's been pretty successful in kind of managing these things in that lonely fight. But I think getting more allies is always going to be a good thing.
Yeah, allies. Yeah, institutional allies to help do the dirty work that he's not going to do. So yeah, next question. Let's see here. From Hoops How on Twitter, what do you think of Starlink competitor Space Mobile? Is there room for multiple winners in the lower Earth orbit internet space? I haven't studied Space Mobile, to be honest. Is that the Amazon project? Is that what that is, or is that something different?
I'm not sure.
Startup. Yeah, Space Mobile might be some other startup. I mean, there's literally hundreds of space startups right now. We can't keep track of them all. We try to keep our eyes on the ones that we think are important or relevant, most relevant. I have not heard of Space Mobile, but we'll take a look if it comes up in our radar. We'll certainly dig into it, but haven't heard of that one. Yeah,
in my view here though is that like low Earth orbit is not where the money's going to be made in the long term. What I like about Rocket Lab is that they have this proven ability to get to low Earth orbit, to be like a reliable commercial provider. Frankly, the second most reliable partner. So their credibility is established in LEO, but I think the value from the business perspective is in what they're calling applications. So right now they're trying to really vertically integrate, and they've been a little bit coy with some of the details. But it sounds like they want to build their own constellations and kind of provide services to Earth from these kind of in-house built and launched satellite constellations. And then they're going to do more kind of beyond that as well. But I don't think when you're thinking about the kind of all these space startups, I don't think the LEO TAM is in kind of like splitting that up among a group of winners. Is the right way to look at that. I think it's going to be a much larger market when you've got kind of lower cost services that can be provided from constellations like Starlink, like some of the things that Rocket Lab has been hinting at. But in my mind, that's kind of the order of magnitude bigger opportunity than just kind of like LEO launch services.
Yeah, I would agree with that. Any new thoughts on Lemonade? Might this be a good time, given the stock price drop, to add more shares? Yeah, I mean, long term, it looks like a lot of these growth stocks are taking a dive today, Lemonade included. But I'm still bullish long term on Lemonade. We have a significant exposure in our fund. It's down to $62 or $63 right now. 3.8 billion valuation. I was comparing it to Trupanion, which is like the main pet insurance provider, and they have a real in with veterinarians and such. Trupanion's 4.34 billion market cap, and that's really just pet insurance, as far as I know. I mean, I haven't studied them carefully, but I know Lemonade is fast growing in the pet insurance space, but they've also got renters, and car insurance is the real big one for Lemonade. That could take a little longer to kind of come to fruition than I think people expected early on. We see Tesla struggling with car insurance. They were talking about it's going to take a lot longer to get a state-by-state approvals, and Lemonade started probably similar time to Tesla, but they probably don't have as many resources to be able to dedicate towards it as Tesla does, and we'll see. But I'm still bullish on Lemonade. So yeah, we'll have to see. It seems like a very low stock price, relatively speaking, $62, but it could go lower. So it's hard to say. Do you offer services to European investors? Yeah, I mean, our fund can take European investors, so that's not a problem. If you go on our website and go to the contact us for more information and you meet our requirements, then yeah, we can certainly take on European investors. I know Canada we cannot, but most of the world is not an issue. Uh, from Nick E, are you all exposed to crypto? If not, do you plan on it? I personally believe once spot ETF releases, it will open the floodgate for crypto. I mean, I think crypto. We do kind of play around in the crypto space through MicroStrategy, right? We kind of sell volatility, or kind of do some options plays, selling options. And personally, I think we've disclosed we both have some crypto. So I mean, the Bitcoin ETF came out for futures, and that's a huge floodgate right there. The spot ETF will be a bigger floodgate. So yeah, I mean, crypto seemed, the Bitcoin at least, and Ethereum, and yeah, I don't know. What do you think, Matt? Do you think they're gonna? Do you believe the spot ETF is going to make a huge deal versus what's going on so far, or what are you thinking?
Yeah, I'm not sure that a spot ETF is going to be the kind of like the one thing that kind of opens the floodgates. I think what you're seeing with some countries kind of making it legal tender, that's I think a really important symbolic step. It's probably not moving markets necessarily, but I think it's a really important kind of symbolic step on the path to kind of greater exposure. And then I think we've seen institutions kind of becoming quiet on this. I think maybe we were thinking there'd be more companies following in Tesla's footsteps to hold crypto on the balance sheets, and that hasn't really happened in a much more meaningful way yet. But I do kind of think that things are trending in the direction where that will become more common over time. And just frankly, as the government, at least here in the US, seems to be getting kind of more irrational with spending, and then like these wealth taxes and this potential for kind of runaway inflation, there seem to be poor decisions being made, and I'm seeing all these poor decisions that are being made, and I'm kind of fast forwarding 5 years to what I think the likely implications of these decisions might be. It makes me more bullish on crypto as a kind of a personal hedge, and worst case scenario, kind of like a get out of the country. Not that I would really do this, but I think there's a lot of people that would look at this, be like, okay, if you're gonna impose like a wealth tax where you're going to take like 20% of a high net worth individual's wealth, it might make sense for them to start holding crypto and just say like, let's get out of here and live somewhere else, because everyone can work remotely anymore. And I think government might be overplaying their hand here a little bit. So I think those are the trends that I'm looking at a little bit more closely.
Yeah, I agree. I mean, I think digital gold is going to, if there is one, which seems like Bitcoin's going to be that, and there's certainly a place for it in the future. We're moving towards, and Bitcoin's here to stay, and yeah, I mean, we are exposed to Bitcoin to some degree, and it's part of our portfolio personally. The fund itself cannot invest directly in crypto, but we try to get some exposure through some other avenues.
Yep.
From Ryan Sakasov, did you guys hear about Honda announcing their level 3 autonomous technology? They are currently testing out stage 4. Do you see any potential for them to compete with Tesla? I'm not familiar with specific Honda. There's announcements all over the place about this from every car company. If the car companies are not making announcements about this, they're, the people, the decision makers there are getting fired, or marketers are getting fired. So the test for this is like, when can I try the Honda level 3 autonomous technology? Personally, like I've had enough people. I haven't tried the GM cruise control myself, but I've spoken to people who have, enough people, real people who have, not just reviews on magazines, that virtually all the other advanced driver assist systems, level 2, level 3, whatever you want to call it, are really not very good compared to Tesla's. So until I see people, regular everyday people, testing out this stuff and using it themselves and saying, wow, this is as good as Tesla, then I don't think of it as a threat. What do you think, Matt?
Yeah, I mean, I think you can point to other companies that are more advanced within certain aspects of autonomy. I think we had a really good conversation um, with Taylor Ogan about some of the Chinese competitors out there that have really good autonomous systems, and frankly, some that within geofenced locations can handle things probably better than Tesla's current state can handle. But in my mind, the question is, how can you scale to provide, level 5 robotaxi services, globally, or at least kind of within a large addressable market of, say, the United States, and do that at a relatively low cost, such that your margins are like reasonable.
Yeah.
I
How do you
don't.
mass produce them? How are you going to get to a place where Hertz can order 100,000 of them, right?
Yeah, exactly. And you can produce them with a margin on your hardware, and then you get software revenues as well.
Yeah.
So LiDAR costs are falling. That's a like a fair point, but to me, it just makes sense that you need to solve vision like incredibly well. This is kind of that quote that from Elon that I had on that Taylor Ogan interview we did. But you like to have true autonomy, I do believe you need to have vision solved incredibly well. And at the point at which you've solved vision incredibly well, what's the point of LiDAR?
Yeah.
So I think there's reasonable questions of like the B pillar camera versus maybe you need some hardware for that could be true, but I think we're gonna have hardware for probably this time next year anyway. So I just there may be others that are right now look like they're competitive or better under certain routes, but I think you need to look at rate of improvement and kind of what does that marketplace look like once you've actually solved it. What's your cost structure? How big can you deploy that technology, or how wide can you deploy that technology? So I think Tesla's the clear winner there.
Yeah. Next question from Chris. Rocket Lab. I looked into Pete Beck and Rocket Lab financials. Looks good, but isn't this also a bet in the growth of space services? Feels like a 10-year bet. Yeah, I agree 100%. This is a bet in the growth of space services, and we are betting that Rocket Lab is number 2 behind SpaceX. That's exactly what this is. And whether it's a 5-year bet or a 10-year bet, that's questionable. But we are betting that investors consensus, at some point in the relatively near future, 6 months, 12 months, 24 months out, somewhere like in that range, investors' consensus will be that Rocket Lab is number 2. They'll realize Rocket Lab will be number 2, maybe 3 to 5 years from then, if not already like, knocking on the door of SpaceX with a lot of contracts and such. So that's kind of our bet and thesis on Rocket Lab to a large degree is we're just trying to get to the, greener pasture, so to speak. I know Dave Lees has a metaphor with that. So we're trying to get to the greener pasture on space investing before others. And I think Rocket Lab is a valid option for that. Matt, you have anything you want to say?
Yeah, the only thing I'd add is, we talk a lot about kind of like options plays that we have, but in this case, we've got exposure to the stock and to some long dated warrants, which go out even further than the longest dated leaps do. So we do view this as a longer term option. It wouldn't surprise me if that sentiment really changes in the next 6 to 12 months, and of course we could always exit if that happens. But this is, I do agree, it may take some time to pan out. So we don't have any sort of exposure that can go to zero, kind of the way some leaps might traditionally do.
Yeah, we're happy to hold on to this Rocket Lab position for a long time. Yeah, I mean, Similarly, holding on to Tesla from 2014 to 2019 took years to pan out. We're going to keep studying Rocket Lab and developing our conviction. And if we come across some other service, some other founder, some other company that we think could be competing, knocking on Rocket Lab's door and developing launch services competitive or better than Rocket Lab, then we'll know, okay, maybe we should exit Rocket Lab. Maybe the thesis isn't right anymore. But we're going to keep searching for that. And so far, we haven't found anything close to it.
Yep.
Tesla's green, by the way. All right. After no, it's red. Flat to green, red, every other print. Okay. Next question, Matt. With Megapack factory ramping, what's your outlook on energy storage?
Yeah, so I'm not sure if everyone saw this chart that was in the investor letter on the Q3 call, but there was a chart which was kind of eye-popping. I think it was on page 9 for anyone who wants to pull it up, but it was essentially a chart of their historic Megapack deployments. And it was, I forget the exact number, but it was a very small kind of like chart that was kind of growing. And then there was this massive bar, I think it was 35 gigawatt hours, that was their planned, this is the key word, dedicated Megapack capacity. So, the energy side of the business has always kind of been what I've been calling the redheaded stepchild of the energy business. It kind of got, or of Tesla's business, it got whatever leftover cells were, needed for, vehicle sales, which has historically been not very many. So they've always been kind of cell constrained on Megapack deployments. They've talked about at Battery Day, I think they said they had something like a 2 to 3 year Megapack backlog. So it's like they've got more demand than they can handle. And so the financials and the deployments haven't looked that great just because they've not had the supply. So I was frankly surprised that they were going to be building that much. I mean, 35 gigawatt hours is like the size of Giga Nevada. It's a huge amount of capacity that they're bringing online solely for energy. So I think you're going to see that probably surprise some people because most people, like if you look at the Adam Jonas notes, or if you look at any of the Wall Street analysts out there, they put zero value on energy. They're just like, it's small, and even if it grows, it rounds to zero. And I have some sympathy for that point of view. But that's going to change in the next 5 years. And it's going to be a little bit of a slow burn. It's not like 2022 is going to come and all of a sudden there's like $1 billion of energy gross margin. It's not going to happen that quickly, but it's going to be kind of this steady chipping away. And I think it's going to surprise people, especially how good the margins are. So I'm looking forward to that story because I think that's going to be really disruptive. I mean, I think a lot of energy companies have not felt the hurt of this transition yet. But I think the pain is going to start to really increase for the incumbents in this space, which is one of the big reasons I wanted to leave my old job.
Good answer. All right. From Jiru Thandapani, in order to make 20 million, we'll make this the last question. It's almost 10:45 here. So in order to make 20 million vehicles by 2030, Tesla must at least make 3.5 million vehicles by 2025. How soon Tesla needs new gigafactories to achieve this target? I think Tesla could expand its current factories to make 3.5 million vehicles a year. Like I think Austin could be expanded to make 1.5 million vehicles. Giga Berlin could be expanded to make 1 million vehicles, and Shanghai and Fremont could do the rest. So I think they have the current footprint for factories. They maybe have to build an expansion onto the Austin factory, and maybe an expansion further into Giga Shanghai or something. And they're already planning, they said on the earnings call, they have plans to try to increase output by up to 50% at Fremont. I think they said from 400,000 to 600,000 per year or something. So, and that's just in like the next year or two, so by 2025, that's 4 years from now, 3 to 4 years from now. I don't see a problem with 3.5 million vehicles by 2025 with the current, factory plans, and 20 million vehicles by 2030. Yeah, they're going to have probably the Gen 3 model up, released by then, I would think, or not the Gen 3. I mean the $25,000 version, whatever they're going to call it, and they can expand a new giant factory in China pretty quickly, maybe build another factory in the US and in India and somewhere else in Europe. So from 2025 to 2030, I think they focused on that a lot. And then, the current Model 3 Y XS Cybertruck lineup might do 5 million total vehicles per year by 2030, conservatively. And then the next generation lower cost model and derivatives of that model, whether it's a hatchback and other things, could do 10 to 15 million. That's my thought. What do you think, Matt?
Yeah, I don't think there's a huge problem to get there with 3.5 million under the kind of existing and announced plans. I agree with your take there. So Yeah, not much to really add.
Yeah. I mean, when Elon says something, you got to take it serious. You can't, he says they're aiming to do 20 million vehicles a year by 2030. They might do it before that. I mean, he's been off on his timelines in the past both ways, not just,
Yeah.
So maybe they do 20 million, maybe because the demand is going to be off the hook. Maybe they figure out a way to do 20 million by 2028. I don't know. But yeah, I mean, I take it very seriously. This 20 million a year by 2030. I think it's uh, very possible, very likely, in my opinion.
Yeah, I do too. And I mean, you kind of look at the existing landscape. I mean, the existing kind of OEMs aren't really competing. The new companies out there, probably Rivian and Lucid are the ones to look most closely at right now. By all accounts, they're struggling very mightily with production, which, for all of us who kind of lived through, 2018, 2017, that shouldn't really be a surprise that they're struggling so much with production. It's very hard. Yeah. And as Elon tweeted out yesterday, it's even harder to do it profitably.
Yes.
So, Tesla's going to they've got this advantage already in their cost structure, and they're going to have the most buying power for raw materials. They're going to have the most scale for these plants that are going to be more efficient than a startup putting out 15,000 vehicles and trying to hopefully ramp up to like 100,000 in 2023. They're going to be at a severe disadvantage to Tesla, which is launching the $25,000 vehicle by then. So, I think it's going to be a matter of how they can execute on the supply side, not necessarily on what's there on the demand side.
Yeah. And then don't forget the Tesla bot. The Tesla bot prototype is supposed to be ready next year sometime, 2022. The prototype's ready next year. They might be taking orders as soon as next year. And usually when they take orders, it's like 2 to 3 years at most away from delivery, barring the Roadster, which has been.
Yeah, I was going to say, how's your Roadster order doing?
Yeah. It's been delayed for years, but that's okay. But, and the Cybertruck's been delayed, 3 years, let's say. That's the farthest. But usually the Model 3 or Model Y are like a year, 2 years out from when they take orders. And so if the Tesla bot, if they're going to start delivering or producing them in, let's say, 2024, 2025, in early phases, and maybe 2026, 2027 massively, I mean, the second half of this decade, manufacturing is going to look completely different than what it does now. Like ramping up manufacturing will be completely different. Like you won't need nearly as much human labor. You won't need to train humans as much. You'll train, I think there'll be Tesla bots doing things by the end of the decade. I mean, it's not going to be right off the bat, but a lot of advancement can be done in these Tesla bots over 5 years between 2024 and 2029 or whatever, when they first come out versus, when they're being mass produced and refined and neural networked to the moon, so it's going to be, neural network, like, you'll be able to download all kinds of stuff. So by the end of this decade, the world is going to be so different than what it is now. I mean, we're living in a time of technological acceleration, and that's sort of one of my, I feel like, advantages in investing is if you can have that mindset of like, okay, things are advancing faster than most people expect because it's always getting faster than it has in the past. And if you can keep that in mind, but also balance it with not being too excited that things are going to advance like so fast that like these Tesla bots are out next year. Obviously, that's not the case. But by the end of the decade, I think very likely they're going to be out and about doing all kinds of stuff, So you got to kind of balance it and figure out and then decide what the world's going to look like. And manufacturing is going to be so different, we don't even know, but it's going to be more efficient by a lot. That I do know. So we'll see. Yeah.
Yeah, it's exciting times. Maybe before we end, I have been getting a lot of questions on Bloom Energy since that really spiked up yesterday. So maybe we can just address that real quickly here.
Sure.
So, we put out a short research paper on Bloom Energy. I don't know, what was it, 3-4 months ago, something like that? Maybe it was even a little bit longer.
A little longer,
entered a short position around $27. We ended up selling it. I think it was like around $18.70, something like that. So we made a really nice gain on that stock.
Yeah.
We always try to find asymmetries, and when it got down to that level, I think we had a price target of around $12.50. But that the asymmetry doesn't look as good when you're when you're getting that close to your price target. So we closed out of that position. We've been kind of monitoring it ever since. But then just yesterday, they announced a really large deal with this South Korean company for 500 megawatts of their fuel cells to essentially make hydrogen along with electricity. So it's a meaningful deal given the size of Bloom's kind of existing revenue base. So I do think it's worth kind of a deeper dive in, and we probably need to reevaluate our short thesis, even though we don't have a position right now. But that said, they still have, I think, probably unrealistically high cost for the customer. So I'm going to have I have a hard time kind of believing they'll really be competitive or get much scale. And then the fact that they're like there's all these hydrogen bulls out there that think like hydrogen's going to be the next big thing. And I do think that there's a space for hydrogen, especially in kind of some industrial use cases, like say steel making, where you just need massive quantities of BTUs, and it's hard to get that from solar or wind. So there are some liquid fuels where the density of the energy, hydrogen, might make sense for those use cases. So I think it'll be a small niche, and it's possible that Bloom could be a winner within that, what I think will be a very small niche. But we'll do some more digging, and I think to my mind, like focusing on hydrogen and kind of committing to this incredibly expensive like capital cost technology that they have, it's not going to be cost effective at scale. And I think with their current valuations, probably still overvalued. But like I said, we'll dig into that a little bit more and maybe provide some commentary on this deal in the future. But just since we put that out there publicly, wanted to kind of share our thoughts in real time.
Yeah, no, thanks, Matt. Yeah, and a lot of people have been asking us about Rocket Lab and such, and we'll field more questions as time goes on with that. But definitely, a lot of people I don't think are familiar with our website, goodsoilinvestment.com. And on that website, we post some of our research in the articles section. There's our research is on the Rocket Lab is there. It's a couple pages long and sort of succinctly explains kind of our thesis on Rocket Lab. So with that, I guess we'll talk to everyone next week, and we'll see where Tesla stock price is next week, a week from now. It's been a wild ride just today, so we'll keep a close eye on it. All right, guys.
All right, thanks everyone.